The idea that stock market crashes are unpredictable is only half true. What's unpredictable is timing. What's completely predictable is that crashes will happen again. The U.S. stock market has crashed in 1929, 1973, 1987, 2000, 2008, and 2020. And every single time, people said, this time is different. It never is. Economic cycles repeat because human behavior repeats. Fear, greed, leverage, and overconfidence don't disappear just because technology improves. So when people ask, what are the best ETFs to own if the stock market crashes in 2026? The correct mindset is not panic, it's preparation. The goal is not to avoid volatility entirely because that's impossible. The goal is to survive the crash without permanent damage and position yourself to benefit from the recovery. When a crash happens, most investors don't lose money because the market went down. They lose money because they panic sell at the worst possible moment. That's why the ETFs discussed in this video are not designed to beat the market every year. They are designed to do three things during a crash: fall less than the broader market, provide liquidity or income, and recover reliably once conditions stabilize. This matters because in real life, investors have emotions, bills, and time constraints. A portfolio that drops 50% looks great on a long-term chart, but psychologically, most people cannot hold it. So the ETFs you'll hear about are chosen with behavioral reality, not theory, in mind. The first category of ETFs you want to own during a market crash is broad, high-quality U.S. equity exposure, but not speculative growth. This is where an ETF like VOO, which tracks the S&P 500, becomes critical. During crashes, the strongest companies don't disappear. Apple, Microsoft, Johnson & Johnson, Procter & Gamble, and similar businesses may see their stock prices fall sharply, but their underlying cash flows usually remain intact. These companies have pricing power, global demand, and balance sheets strong enough to survive recessions. Historically, after every major crash, the S&P 500 has eventually recovered and gone on to make new highs. That doesn't mean it's safe in the short term, it absolutely isn't, but it does mean that owning high-quality U.S. companies is fundamentally different from owning speculative or unprofitable businesses when liquidity dries up. However, owning only the S&P 500 during a crash is still risky because crashes are often triggered by tightening financial conditions. Higher interest rates, tighter credit, and economic slowdowns hit equity valuations hard. That's why diversification across asset types, not just companies, becomes essential. One ETF category that historically performs well, or at least holds up during crashes, is U.S. Treasury bonds. This is where ETFs like TLT or IEF come into the picture. When fear spikes in the market, capital often flows out of risk assets and into U.S. government bonds. The U.S. Treasury market is considered one of the safest and most liquid markets in the world. During severe recessions, long-duration treasuries have often acted as shock absorbers, rising in value while stocks collapse. This negative correlation is not guaranteed in every scenario, but historically, it has been one of the most reliable hedges for equity investors. Another ETF category that becomes extremely valuable during a crash is dividend-focused U.S. equities, particularly those with a history of consistent dividend growth rather than high-yield chasing. An ETF like SCHD focuses on companies with strong cash flow, sustainable payout ratios, and a track record of increasing dividends. During market crashes, prices fall, but dividends often continue to be paid. That income provides both psychological and financial stability. Investors receiving cash flow are less likely to panic sell, and they can even reinvest dividends at lower prices, accelerating long-term compounding. This is especially important for U.S. investors who rely on portfolios for partial income or who are nearing retirement. In addition to traditional stocks and bonds, Crash-resilient portfolios often include defensive sectors, industries that people rely on regardless of economic conditions. Healthcare, consumer staples, and utilities fall into this category. ETFs, like XLV for healthcare or XLP for consumer staples, hold companies that sell essential goods and services. People don't stop buying medicine, food, or electricity during recessions. While these ETFs are not immune to market downturns, they historically experience shallower drawdowns compared to cyclical sectors like technology, discretionary spending, or small-cap growth. Including defensive sector ETFs can reduce overall portfolio volatility without eliminating long-term growth potential. Now, here's where most people mess up. They assume that preparing for a crash means abandoning growth entirely. That's a mistake. The best opportunities are often created by crashes, not despite them. This is why owning total market ETFs like VTI remains important even in a crash-focused strategy. VTI provides exposure to small and mid-cap companies that often get hit hardest during downturns but can outperform dramatically during recoveries. The key is position sizing. You don't overweight risk during uncertain times, but you don't eliminate it either. Long-term wealth is built by staying invested through cycles, not by trying to sidestep every downturn. Another overlooked but critical ETF category during market crashes is gold and precious metals exposure. ETFs like GLD don't produce cash flow and shouldn't dominate a portfolio, but they can act as a hedge during periods of extreme uncertainty, inflation fears, or currency instability. Gold has historically performed well when confidence in financial systems weakens. It's not a magic shield, and it doesn't always move opposite stocks. But during certain crash scenarios, especially those involving monetary instability, it can protect purchasing power. For U.S. investors, this diversification is about insurance, not speculation. One thing that must be addressed honestly is inflation. Not all crashes are deflationary. If a 2026 market crash is driven by persistent inflation, supply shocks, or geopolitical instability, traditional bonds may not perform as expected. In those cases, ETFs that focus on Treasury inflation-protected securities like TIP become relevant. These instruments adjust with inflation and can help preserve real purchasing power. Most investors ignore inflation hedges during bull markets and desperately search for them during crises, which is exactly backward. Preparing in advance is what matters. At this point, it's important to clarify something that many finance YouTubers avoid saying out loud. ETFs do not eliminate risk, they manage it. During a true market crash, almost everything goes down. The difference between a good ETF portfolio and a bad one is not whether it avoids losses entirely, but whether it avoids irreversible losses. Companies can go bankrupt. Entire sectors can disappear. Broad, diversified ETFs dramatically reduce that risk. This is why owning leveraged ETFs, niche thematic funds, or ultra-concentrated positions going into a crash is extremely dangerous, no matter how good they looked during the bull market. Another major factor U.S. investors must consider during a crash is liquidity. ETFs that track large, liquid markets, like the S&P 500 or U.S. Treasuries, tend to function better during periods of stress. Thinly traded ETFs can experience wider bid-ask spreads, tracking errors, or forced selling. This is why simplicity often beats complexity during crises. The more exotic the product, the higher the chance it behaves unpredictably when volatility explodes. Let's also talk about time horizon, because this is where advice often becomes useless. A 25-year-old investor and a 55-year-old investor should not prepare for a crash in the same way. Younger investors should view crashes as accumulation opportunities, focusing on ETFs that allow them to buy more shares at lower prices over time. Older investors should prioritize capital preservation and income stability, emphasizing bonds, dividends, and lower volatility assets. The same ETF can be either a weapon or a liability, depending on who is holding it and why. Now, something that almost no one explains clearly: owning the best ETFs for a crash is meaningless if you don't rebalance. Rebalancing is what turns volatility into an advantage. When stocks crash and bonds rise, rebalancing forces you to sell what held up and buy what's beaten down. This is how disciplined investors systematically buy low without guessing bottoms. Without rebalancing, even the best ETF selection becomes passive and ineffective. At this stage, it should be clear that preparing for a potential 2026 market crash is not about fear, it's about structure. You're not betting on disaster, you're acknowledging uncertainty. The U.S. stock market rewards patience, diversification, and discipline over time. Investors who prepare emotionally and structurally for crashes are the ones who come out stronger on the other side. Another mistake investors make during crashes is thinking they need to do something every time the market moves. In reality, the biggest advantage ETFs give you during a crash is the ability to do nothing without self-destructing. When you own diversified ETFs across U.S. equities, bonds, dividends, and defensive assets, you're not relying on a single outcome. You don't need perfect timing. You don't need to predict the bottom. You simply need to stay invested and let the structure of the portfolio do the heavy lifting. This is why professional money managers spend more time on asset allocation than on stock selection, because allocation explains most long-term returns and risk outcomes. If a market crash happens in 2026, the worst possible response for most U.S. investors will be moving entirely to cash after prices have already collapsed. Cash feels safe emotionally, but it's a silent destroyer of purchasing power, especially in an inflationary environment. Historically, some of the strongest market rebounds happen within months of the worst panic, often when headlines are still negative. Investors who sell everything rarely get back in at the right time. ETFs are powerful because they allow you to stay exposed to recovery without betting on individual companies surviving. When the market recovers, ETFs recover with it automatically. It's also important to understand that crashes don't affect all assets at the same speed or intensity. Equities usually fall first, credit markets tighten next, and economic data confirms the damage last. ETFs that track bonds, dividends, and defensive sectors often stabilize earlier, giving portfolios breathing room. This staggered reaction is exactly why mixing ETFs works. You're not trying to be clever, you're trying to be resilient. Resilience beats brilliance in investing, especially during downturns. For investors who continue adding money during a crash, ETFs become even more powerful. Dollar-cost averaging into broad market ETFs during periods of fear has historically produced strong long-term outcomes. Buying when prices are lower increases future return potential without requiring perfect timing. This is where many investors say they will act rationally and then fail emotionally. Preparing in advance by deciding which ETFs you'll keep buying during a crash removes emotion from the process. You're executing a plan, not reacting to headlines. Another uncomfortable truth is that media narratives during crashes are designed to scare, not inform. Financial news thrives on urgency and fear because fear keeps people watching. If your investment decisions are driven by headlines instead of strategy, ETFs won't save you. The investors who benefit most from diversified ETF portfolios are the ones who consume less noise and focus more on fundamentals, allocation, and time horizon. The market does not reward constant attention. It rewards patience. Now let's bring everything together clearly. The best ETFs to own if the stock market crashes in 2026 are not magic tools that prevent losses. They are tools that control damage, preserve optionality, and position you for recovery. Broad U.S. equity ETFs provide long-term growth. Treasury and inflation-protected ETFs provide stability and protection. Dividend-focused ETFs provide income and emotional discipline. Defensive sector ETFs reduce volatility. And diversification across these categories ensures that no single mistake destroys your financial future. If there is one final lesson to take away, it's this: crashes are not the enemy. Poor preparation is. Every major market crash has created long-term wealth for disciplined investors and permanent damage for emotional ones. The difference wasn't intelligence. It was structure, patience, and behavior. If you're investing in the U.S. market, your goal shouldn't be to fear the next crash. It should be to be ready for it. And the right ETFs, used correctly, are one of the most effective ways to do exactly that. If this helped clarify ETFs to own, if the stock market crashes, smash that like button, subscribe for more no BS breakdowns, and comment below which ETF are you most interested in. Drop your questions. I'll reply. Thanks for watching. Stay smart with your money. See you in the next one.